I'm Greg Hunter. Welcome to USAWatchdog.com. Well, thank you for joining us today. And I have a recurring guest, Michael Pento of Pento Portfolio Strategies at pentoport.com. Michael just wrote a big article called Reality Check Now in Progress. And the rosy economy is not so rosy, is it, Michael?
Well, it's rosy only here in the United States if you own tech stocks. But if you look around the world, you'll see the start of what I call the reality check. And I wrote a commentary. It should be on my website now. If you go there, it's pentoport.com. It's called Reality Check Now in Progress. And, if you're just myopically focused on the United States economy and its stock market, you might not realize what's going on around the world. So let's just backtrack for a second. We all should know now, but maybe we don't. So, I'm sure you have a new audience coming on every day. I know how popular you are and how fast your audience is growing. But we should all know now, Greg, that central banks printed $14 trillion worth of counterfeit confetti. Okay, so fiat money, new fiat money, to rescue us from the financial crisis in 2008. And what did that do? That brought asset prices out of the dust. It elevated the stock market to a record 150% now of GDP. So the value of equities is 1.5 times the entire value of the economy. That has never before happened. Okay, if you look at the bond bubble, we have some $8 trillion worth of bonds around the world with a negative sign in front of them. Okay, so governments are getting paid to borrow money. Real estate prices are back in a bubble. So what I'm saying is, as long as QE was in place, and QE, the monthly pace of quantitative easing, reached $180 billion. That was the apex. And that's all changing now. So let's not look in the rearview mirror. Let's look through the windshield, as they say. So the monthly pace of quantitative easing is going from that 180 billion per month to zero by the end of this year. Not only that, but the Federal Reserve has hiked rates 7 times. It will do its 8th hike on September 26th. It will probably go again in December, which will probably flatten out or invert the yield curve. So you have 9 rate hikes from the Fed. Not only this, but central banks around the world have turned hawkish.
And
so
this is the chart that you put up here, talking about how this is going to be crashing right in here, right? Is that right? Is that what you're talking about?
Yes. So the monthly pace of QE goes from 180 billion you see in 2017 to negative in 2019. So the flow, what I'm saying is, Greg, the flow of assets, the monthly pace of QE goes from 180 billion to a negative number. All right. So think about it this way, Greg. Let's just say that you're earning, just make it easy, $100,000 a year salary. You're using that salary, and that salary's been growing 100,000, 200,000, 300,000. It peaks at a certain level at 2017, and you're using all that money to buy stocks. Then in 2019, it goes from 300,000, starts heading towards back to 100,000. That's what I'm talking about. The money, the flow of money going back into people's wallets, into the coffers of the financial system, starts heading into a reverse by the end of this year. That's a big number. But not only that, like I said, the Fed's going to go 9 times. The 9th hike will be in December. And if you look around the world, central banks are almost in confluence turning hawkish. The next rate hike from central banks, the next move from the 19 biggest economies around the world, 19 biggest central banks around the world, 14 of the 19 will be another rate hike, with only 5 cutting rates. So this is a trenchant watershed epiphany change in the way central banks are manipulating the economy. They've gone from massive quantitative easings and zero interest rate policies to a policy of raising rates, especially in the case of the Federal Reserve, to a negative net amount of QE. And what is that doing? What is that doing to the economy? What is that doing to markets? Well, like I said, outside of the United States, outside of tech stocks and certain industrials and consumer discretionary, if you look beyond that, the carnage is replete. So emerging markets are down 20% this year, the whole basket of EM. China is down 25% from its high. And if you look at commodities, copper is down 20% from its high. And lumber is down 40% from its high. So that begs the question, if we are in a global synchronized recovery, if we are still in that globally synchronized recovery, why is Dr. Copper down in a bear market? Why are lumber prices crashing? The simple answer. Go ahead.
Here's the free charts now, this is fantastic for free. I mean, this is all the charts. This is the emerging markets going down. This is the Shanghai index. You can see the trend in all these charts. Here's the copper. The 6-month chart in copper is just this big sleigh ride, going down. Here is your lumber chart. Mind you, this is only like what is this? May, June, right here at the peak, right over here.
Exactly.
And then here's just hitting the can, and this is backing up all your research. You have 5-page research paper, which I told you in the pre-interview. I said, "Wow, this is free." Wow.
I'm not sitting here, Greg, making stuff up.
No.
Deutsche Bank, Kitco. I mean, this is stuff that anybody who has the time, and who has time anymore, but this is what I do for a living: manage money and trying to get the dynamics between inflation, deflation, and growth correct. So I get them wrong, then I lose clients. I get them right, and I make a lot of money for me and, more importantly, for my clients. So I'm all about trying to preserve principal, make some money safely, and wait until that model. And I have a 20-point model that models the rate of inflation and deflation and growth. So I know when it's time for this reality check to occur. And what does that mean? I'm going to go net short in my portfolio when the timing is correct. And that's what this model was built to do. But right now, that's not the case. But I have been short in the model portfolio up until a few months ago. Actually, a few weeks ago, I sold my short in emerging markets. I was long the dollar. So these are the things that my model gets right. And believe me, I don't get everything right. But what I'm trying to tell you, what I'm trying to convey to you and to my clients and to your audience is that the Cassandra standing on a hill saying, hey, the central banks printed a lot of money and we have an extra $70 trillion in debt globally and assets are in a bubble. Well, yeah, but this is now starting to unravel now. If you look around the world, it's not just China. Venezuela, Turkey, Argentina, Indonesia, Brazil, Mexico, Malaysia, South Africa, India, Hungary. Go around, I couldn't put all those charts in my research report, but go around the world and look what's happening. All those countries that I just mentioned are in some phase of a currency crisis, a stock market crisis, and a bond market crisis. In some cases, all three. So if you're just, like I said, myopically focused on the United States, you say, well, you know what, things aren't so bad. I look at the ISM report, and I look at retail sales, and I look at GDP, and I look at my tech stocks, and hey, there's nothing to see out there. But if you just broaden your horizon, just broaden your scope a little bit and look at commodities and look at emerging markets and look at China and look what's going on even in Europe, and you say, hey, the reality check from excess money creation to manipulate interest rates and asset prices is reversing, and it's first showing up in commodities and in emerging markets, and it's coming to a theater near you soon.
Coming to America, correct?
Yes, that's exactly what I meant.
It's what do you make of the Fed talking about raising rates? If you look at the Fed's numbers, it's around 2%. If you look at John Williams, who I trust more than the Fed, it's around 10%. It's right at just 10%, like 9 point something. It's up there.
What are you talking about? The unemployment rate? Or
no, the inflation rate.
Inflation rate.
The inflation, the real inflation rate, if you did it the way it was in 1980, John Williams strips off all the gimmicks and says, okay, here's the real inflation rate the way they used to do it. Right. And it's, near 10, right at 10%.
Before the Boskin Commission, we're going back to the 80s and 90s, before the massaging of all these metrics, now we're looking at, Greg, we're looking at the core PCE deflator, so such an arcane metric. You know what's not in the CPI? Your home price. What they do is they use something called owner's equivalent rent. How much you think you might be able to rent your house out if you no. Why don't you go look at the data that shows home prices are back in a bubble? That's the data. The home price to income ratio is at 4.7. It used to be 3 forever. It was at 5.3 at its apex. So if you look at things like home price to incomes, by the way, just look at the home price in itself, which is not part of the CPI. It's been growing close to double digits, 6, 7, 8, 9, depending where you are, 10, 11, 12% per annum. So there's a lot of things that aren't in the CPI, and especially the PCE deflator. So inflation is much, much, much higher than what they say. Absolutely. No doubt about it.
Do you think that the Fed knows this? I mean, they employ out of 500 economists, PhDs. Do you think the Fed is going to go for the rate hike?
I'll tell you why. You know what else is in it? I forgot to mention.
Go ahead.
I'm 55 this week, so
happy birthday.
I forget things once in a while. You know what else isn't in the core PCE deflator? Asset prices, stock prices. Stock prices are in a huge bubble. And you know what the truth is? And listen, I know some of these, tangentially, some of these people in the Federal Reserve System. I got to tell you something. They're more worried about asset prices than they're letting onto. That is what they're really afraid of. That is the real reason. There's two main reasons why they're raising rates. Beyond the fact that inflation is much higher than what they claim, they're worried about the asset bubble bursting, and especially in stocks. And they want to get some ammo so they can lower rates when the next calamity hits. There was a Federal Reserve.
So you think? Hold on. There was a Federal Reserve. I'm going to bring you back to that. I will bring you back to that. But you think they're going to raise rates 2 times before the end of the year, not once, not just in December, September, and.
My base case scenario is they go September 26th for sure, 100%.
And they raise rates.
They raise rates 25 basis points, and then they raise rates again in December.
Are they?
I think that's my. I'm less convinced about the second one. The only caveat I would say, if the yield curve were to invert before then, and that's entirely possible. Or they're also modeling the tariff situation, which is almost impossible to get right. One minute Mnuchin says there's no tariffs, and then Trump comes out and he puts another. I think he put another 10% on $200 billion this morning. Indicate that's going to go into effect September 24th. I think that's the right date.
Yeah.
Then China is going to retaliate on $60 billion. So you have 25% on $50 billion. And then if China retaliates, then Trump said he's going to go for the remainder, the balance of our trade deficit with China. So if that happens, maybe, and there's a small maybe there, they don't go in December. But my base case is they hike rates 50 more basis points, 9 times in total, between now and the end of the year.
Do you think that this rate hike, are they worried about the emerging markets, blowing up, all the countries you named, and having all these various sundry currency crisis, bond crisis? Are they worried about raising rates and jacking the dollar up, and them, saying we're not paying? I don't know. I mean, are they worried about that? I don't know.
I don't think from what they say. They cannot be the central bank for the world, even though they are, because let me just finish the thought. So they probably are much more concerned about the asset bubble's extent here in the United States. Okay. But here's the problem, because these silly individuals at the Federal Reserve think that they're God. They play God with the most important price known to man in economics, which is the cost of money. So they said, let me see, let's take interest rates to 0%, leave them there for a decade. And then, Wall Street, of course, says, well, I need yield. Where am I going to go get yield? I'm going to go to places like Argentina. And I'm going to loan money to Argentina, but I really don't want to buy a bond in Argentina that's backed by the peso. So I'm going to buy a bond that's linked in dollars. Now this is they've done this. They've done this to the tune. There's $11 trillion worth of dollar-denominated debt outside the United States.
That's why all these countries owe this money, because they said, no, we're not going to borrow them in your currency. You're going to borrow them our currency.
Yeah. So if I'm the U.S., listen, I'm going to go and get the extra yield, but I really don't want all that currency risk. But that's a fallacy. You do have currency risk, because when the Fed goes on a unilateral rate hiking spree 9 times, and the rest of the world is still in QE and only slowly raising rates in some cases, but they're still far behind. They've no doubt gone from very, very dovish to hawkish, but they're still far behind the Fed, who, by the way, in a couple of weeks is going to be selling $50 billion of bonds on their balance sheet per month. That's $600 billion in fiscal 2019, which starts in October. And they're raising rates 9 times. By the end of this year, it'll be the 9th time they go 25 basis points. That's a pretty hawkish central bank compared to the rest of the world. So what happens is the dollar rises, and all of these countries that borrowed in dollars and have to buy those dollars, have to pay back that loan in their domestic currency, which doesn't buy a lot of dollars, are in deep trouble. They're so much in trouble that they're facing insolvency. So the Fed is the central banker to the world, whether they want to admit it or not. So I expect the fall. I've said all along, Greg, 2019 is going to be a really, really difficult year for stocks. That's probably the time I'm going to go net short. But I said it would start in the fall. And I've been correct. I mean, the fall hasn't really started yet. It starts in a week. But you think about the additional 2 rate hikes, plus the increase in quantitative tightening on the part of the Fed, plus the ECB in a couple of days goes from 30 billion euros in QE to 15 billion euros in QE, down to 0 by the end of the year. That's what they said they're going to do. Okay? You have 14 other central banks around the world that will be hiking interest rates between now and the end of 2019. So these are the reasons, and I can give you a lot of other reasons. I'm going to name a couple of them if you don't mind.
Sure.
The House of Representatives is projected to go Democrat in the fall, which means whether you like Trump or not, the poor guy is going to be, suffering through investigation after investigation after investigation instead of reducing regulations, which I think that's the best thing that he's done for us.
I don't think they're going to lose, but go ahead.
Well, let's hope you're right, but that's a possibility. That's a very big possibility. Yeah. But the most important thing is that what is happening to emerging markets is not just a function of the Federal Reserve of the United States. China, which went from $1 trillion of debt just before the year 2000, now has $30 trillion in debt. And study after study has shown when you have anywhere near that kind of increase in debt, the economy implodes. So China is in a deleveraging mode. They're in the deleveraging process. So when China delevers, that's where all the growth in the world was from. China in 2016 went through the largest stimulus plan known to mankind. And that boosted emerging market stocks, and it boosted commodity prices. So they're reversing that. So you have hawkish central banks, you've got the QE going negative, you've got China, that debt pile teetering on a ledge, and you have, one more thing I want to mention. Year-over-year comparisons on earnings growth are going to go from the mid-20s to the low single digits. That's probably one of the biggest hurdles the stock market has to overcome. And of course, corporate buybacks from the repatriation of foreign earnings. That's been going on since January. So the bulk of that's going to be behind us in 2019. So you have a lot of reasons why I'm probably going to go net short, depending on where my model says these economic data points are reading. But I'm probably going to go net short in the portfolio in 2019. Because when the collapse comes, Greg, it's going to be monumental and epic. It's going to be one of the worst collapses we have ever seen, if not the worst, in my opinion.
And you think that the real collapse starts now, but happens in 19?
I think that it is starting already. No, I don't think that. It is a fact that if you look at Chinese shares, if you look at all those countries I mentioned, if you look at commodity prices, the collapse is already starting. I think it comes starts here in the fall, and it really diffuses around commodities and assets in general in 2019.
How do these emerging markets, do they reach a point where they just say, we can't pay? I'm sorry, we're Puerto Rico.
Argentina already did that. They already went to the IMF for a bailout, and IMF said no. There is no free lunch, Greg. You can't.
You think all these countries are going to throw their hands up and say we're not going to pay?
We're going to default. It'll be a deflationary default. It'll be a bail-in like they did in Cyprus and in Greece. Turkey is saying, okay, we finally have to raise interest rates to like 40% to defend the currency. I mean, some of these interest rate hikes are not just the kind of like gentle 25 basis points here, and we wait a couple of months, maybe we skip a meeting and we go another. Some of these interest rate hikes are just massive, and they're done so to protect the crumbling currency. And that's not a free lunch. Well, hey, you stem the tide of the collapse in your currency, but now when you go to get a mortgage loan, you're paying 40%. So the economy collapses. So how do you pay back debt? Well, maybe I could make it easier for me to pay you back your 100-year loan, United States, and the rest of the world that Argentina borrowed. But if the economy is crumbled, how do they remain solvent?
Could the banks, all this debt on the bank's balance sheet, could they just take a huge hit? Like they're counting that as an asset, and when all these countries just say we're not paying, they're not paying. Well, we're not going to pay. Well, they're not going to pay either, so we're not going to pay either. So they're not paying. Whoa! Those guys aren't paying. We're not paying either. I mean, couldn't that happen? Couldn't there be a circular firing squad of people defaulting?
Greg, you're absolutely correct, but it's not just Brazil and Argentina and Turkey and Poland and that whole litany of countries. In the United States alone, let's just look at what happened in the United States. So GDP, partly due to the fact that money was free, GDP increased by about a third since 2008. But you know what increased by a lot more than a third? The national debt of the United States increased by over 100% in that same time frame. So much for the Keynesian multiplier. I guess it's really a Keynesian divider, But the deficit of the United States now, if you look year over year, the year-over-year deficit is up 33%. And that's when, that's 5% of GDP. And if rates were to normalize, the annual deficit in the United States would be 10% of GDP. That's Banana Republic. So, when you say a daisy chain, it might not just be Argentina that defaults, but it could be the entire world. But first, before that happens, and I think the Federal Reserve, you're going to remind me, but I reminded myself about the Federal Reserve. The Federal Reserve went on record, and they talked to Steve Leisman of CNBC, who's really very well connected to the Federal Reserve. He loves the Federal Reserve, and he's very well connected to it. Federal Reserve said that they made some mistakes in 2008. One of the mistakes they made is they acted too slowly. Too slowly? They were lowering rates in 2007. They took them to zero by 2008. I mean, they went very quickly. They're going to lower rates even faster this time. But Greg, but the next time this recession hits, they're only going to have about 250 basis points, not 525. They also said that they were going to go into quantitative easing much quicker and much faster. And they didn't even rule out negative interest rates. They said they were going to, in other words, what they said, the mistake that they made is they were going to go all in immediately at the first sign that things have gone bad. And so at the first time they understand that that we are headed for the next global meltdown, boom, all in right away. And that includes negative interest rates, universal basic income, and they also said that another massive fiscal stimulant is needed. Now, when you have 21 trillion in debt, and I know you did some great research that there's just an extra 21 trillion that's hiding out there some way.
It's not mine. It's Dr. Mark Skidmore at University of, I'm glad you brought that up. Dr. Mark Skidmore, just so people know, Dr. Mark Skidmore, Michigan State University, is a PhD, he's an expert in public budgets. He got together a team of PhD level students, master students, and they, with government records, government Inspector General reports, which they now removed from the internet, said that, there's 21 trillion in what's called missing or unadjusted expenditures, undocumented expenditures. I don't know what that, missing money. And then the government's response was to say, not, oh, you're wrong, Dr. Skidmore. It's a national security issue. And I kid you not. They didn't say he was wrong. He said the 21 trillion, yes, it's a national security issue.
Yeah. Well, so they didn't deny it. They said it's a national security issue. So in other words, don't talk about it or else. So,
yeah, but you're managing money.
My takeaway from it.
What's your takeaway for the additional? I mean, I got people writing me who are managing money around the world saying, "Wow, they confirmed it. That's heavily playing into our." So when they go all in, and you add the 21 trillion that we have in the federal deficit, and the 21 trillion that nobody's talking about because it's a national security issue, and they're all in, what happens to gold and silver?
Oh my gosh, they will explode. Because, you were asking before about diffusing and metastasizing default cycles. I mean, let's just say I'm right and a recession does happen. They didn't outlaw the business cycle. Very likely in 2019, by the way. Very, very likely. Well, deficits go from $1 trillion, what they already are, $1 trillion. A 33% increase in good times, Greg, because we can't stop spending money. And we cut taxes without cutting expenditures. We raise expenditures. So deficits go from $1 trillion, which they are now, up another 1.2 trillion. So you're talking about $2.2 trillion deficits. You add that to the $21 trillion debt times 2. If your research is correct and that other individual's research is correct. And by the way, if that debt does exist, you have to say, well, what balance sheet does it exist on? It exists on the Federal Reserve balance sheet. They just they surreptitiously and massively monetize that debt permanently. So that's more inflation, more of that base money built into the system. And then when pension funds go insolvent, because they're already way underfunded, to the tune of I'm not saying this, $4 trillion worth of public pension plans are underfunded. $4 trillion. When the stock market collapses, that number is not going to just double. It's going to probably triple. So my question is, when the stock market melts down and deficits are rising to 10% of GDP, and you already have 105% debt to GDP out there, where is the money going to come from? It has to come from another unprecedented tidal wave, tsunami of money printing from the Federal Reserve. And if that doesn't get gold and silver, which are on death's door, awaken from their slumber, then nothing will. But there's a reason, and I have a model that's built that told me to underweight gold. The reason why you have underweighted gold, because these are mostly morons, by the way, that are trading gold and silver. These are headline reading algorithms that say dollar up, gold and silver down. Okay, real interest rates are rising, so nominal rates are rising, and they're rising faster than inflation currently. So real interest rates are rising, so gold and silver down. But when those two factors turn, and they're going to turn hard, most likely next year, then those headline reading algorithms are going to start buying gold. But there isn't really any gold and silver out there to buy, because it's all paper. All these short sales are done on paper. So the physical demand for precious metals is going to skyrocket. But then, I'm not sitting here. I'm not some Cassandra perma bull on gold who's had 50% of his portfolio in gold and just saying the same thing over and over again. When I come out and tell you, hey, buy gold and buy it in a big way, now that's the time to do it, because that means the dollar is going to be in a bear market, and that means real interest rates are going to be falling. And boy, oh boy, when the short covering rally, by the way, you look at the CFTC futures positions, they're net short in a huge way, record net shorts. When that rally comes, you're gonna be it's gonna be a dizzying rally.
So you're telling people that you would be a buyer now. The little guy, you would say, go out and buy some coins now. Don't wait for the bottom.
What I'm saying is that the bear market is still continuing in gold. You might be able to pick up a bargain or two here, but I'm saying to you that next year, according to the projections of where my model says we're going, that the dramatic sale price of gold that you have right now, and you should always have 5 or 10% of your portfolio in gold. That's a given. But I'm saying if you want to overweight your portfolio into precious metals and even go into the miners, which by the way go up, history shows they go up hundreds of percentage points very quickly in a raving bull market. That's where you get your leverage. That's still in the pipeline. That's to come.
Michael Pento, you're going to have your article, which is titled Reality Check Now in Progress at pentoport.com. There's a bunch to it. You didn't get really, it's a 5-page long article. It's analysis is totally free. You can just go on pentoport.com. I have a link going to pentoport.com. Michael Pento, thank you for joining us today on usawatchdog.com. It was very interesting. Thanks for covering the 21 additional $1 trillion, which is kind of frightening, really. I mean, to somebody managing money, I mean, oops, what, excuse me, there's another 21 trillion?
The inflationary pressures building that are extent in debt and in base net and base money supply lend itself to believe that the inflationary pressures are going to be unprecedented, the likes of which we have never seen, and may even look the 70s and 80s look quiescent. That's the kind of inflationary insolvency pressures that have been built up, and when they're released, you're really gonna want to own precious metals.
Michael Pento, thank you for coming on and putting your brain on parade and putting out this free research. I said, wow, all these charts and all this stuff, and I said, this is for free. And you were like, yeah, I put it out there for free. I mean, this is like top shelf stuff. It was very
Thank you very much.
It was very interesting. You didn't really get to all of it. I mean, we got the pictures, man, but we didn't really get to all of it. But it's the pictures are worth it. That all of them look like this, you know. I mean, your point is made over and over again with charts going down. So copper and lumber and all this stuff. But anyway, Michael Pento, thank you. Pentoport.com, Pento Portfolio Strategies. Michael Pento, thanks for joining us today on usawatchdog.com.
My pleasure as always, Greg.